In 2011, a man named J.L. Collins wrote a series of letters to his teenage daughter to teach her about money, but she had absolutely no interest in finance, investing, or the stock market. Most of us feel the exact same way. Analyzing quarterly earnings reports, tracking stock tickers, and rebalancing massive portfolios is a miserable way to spend a weekend. We have better things to do with our time. The financial industry sells the idea that investing requires intense, complicated effort. They push labor-intensive strategies and actively managed funds with steep fees. But over the long term, mathematically, these expensive strategies routinely underperform a simple, low-cost baseline. The financial world manufactures complexity to justify these high fees. This industry-wide focus on active trading keeps you dependent on advisors while they siphon away a percentage of your capital year after year. Collins bypassed the jargon and focused on a single objective. He called it FU money. Society defines wealth by what you buy: a massive house, expensive designer clothes, or a brand new luxury car. But pouring cash into depreciating assets locks you into a cycle of earning and spending. It forces you to keep working just to maintain the lifestyle. Collins defines FU money as a specific mathematical threshold. It is the point where the assets you own generate enough growth and income to sustain your lifestyle without a paycheck. Reaching this threshold shifts your focus from the pursuit of objects to the absolute ownership of your time. To reach that point, you have to adopt the mindset of the millionaire next door. This requires understanding that earning a high salary does not make you wealthy. If you make $1 million a year and spend $1 million a year, your wealth is zero. Before you buy a single stock, you have to play intense financial defense. This means aggressively wiping out consumer debt, especially high-interest credit cards, and fiercely resisting lifestyle creep. When your income goes up, your spending must stay exactly where it is. This visualization shows the aggressive savings target Collins advocates, a 50% savings rate. You don't wait to see what's left over at month's end. You immediately slice your paycheck in half, treating that savings portion as a mandatory rent payment to your future self. Mastering this level of defense is the absolute prerequisite. Without a wide gap between what you earn and spend, wealth accumulation is mathematically impossible. Once you have the capital, you need a place to put it. For the average investor, trying to pick individual winning stocks is statistically a losing game over a long enough timeline. Look at this total U.S. stock market index fund. Collins recommends putting all your investments into this single vehicle. You're buying a fractional slice of every publicly traded American company. The index is self-cleansing. Failing companies drop out, and thriving ones are added automatically. You don't have to research individual businesses or read endless financial reports. You achieve maximum diversification across the entire U.S. economy with the absolute minimum amount of effort. But the market isn't a smooth upward slope. Warren Buffett famously compared the stock market to a manic depressive business partner named Mr. Market. Some days he is euphoric and offers to buy your shares for a fortune. Other days he is deeply depressed and tries to sell you his shares for pennies. History shows that these downturns are recurring cycles. Since 1972, the U.S. market has weathered multiple crashes and double-digit drawdowns, yet it maintained an average growth rate above 10% through 2019. If your timeline is measured in decades, these drops represent temporary fluctuations. For a patient investor, a crash means the U.S. economy is temporarily on sale. Success requires the psychological stamina to remain completely inactive when the headlines are screaming for you to sell. If you panic and sell while prices are low, a temporary dip becomes a permanent loss. Decades of saving 50% of your income and buying the whole market will eventually push your portfolio past that specific FU money threshold. When it does, your goal shifts from aggressive accumulation to wealth preservation. Notice how this portfolio model shifts. At this stage, you introduce a total bond market fund, like BND. Moving to an 80-20 split between stocks and bonds creates a shock absorber, smoothing out the violent volatility of the stock market to protect your cash as you begin to use it. This chart illustrates the safe withdrawal rate known as the 4% rule. By taking 4% of your portfolio's total value in your first year of retirement and adjusting for inflation annually, historical data suggests the underlying principal will continue to grow and replenish itself indefinitely. By combining just two broad index funds and adhering to a strict withdrawal limit, you create a completely self-sustaining financial ecosystem that outlives you. Collins built his simple path to wealth around a glaring paradox. Winning the game of money actually requires you to ignore it almost entirely. You keep your living costs low, you automatically buy the entire market, and tune out the noise. By putting your investments on autopilot, you don't just secure your financial future, you free up your present to focus on the things that actually matter.